Hi everyone, it's Jack about another video, and today I'm going to be talking about PepsiCo, parent company of course of Pepsi, Frito-Lay, Tropicana, Quaker, Gatorade, among a lot of other brands. This is a fabulous dividend company that's had 49 years of growing dividends, still just a 67% payout ratio at 2.7%, looks pretty tasty. But the main reason I'm interested in this company is A, they released their earnings today, which are worth talking about, and B, its strength as a defensive stock in the last year. In a year where the market is down 20% plus, PepsiCo is actually up 8% over the last 365 days. It's right in the middle of its 52-week range. And it's performing admirably, like outperforming the market by 20%. And it's still a really large company, $230 billion market cap. And it's not cheap by any means. 26p for the sort of growth we're getting, as we'll talk about in a minute. It's not cheap, yet it's held on to its gains and even grew on them in the midst of a really tough market environment. So I want to talk about that, talk about why it's such a strong defensive company, talk about how it did in its earnings, talk about its balance sheet, its margins and its valuation, and then decide whether I think it's a buy, sell or hold right now. So first up, to talk about the earnings report, and these are just the headlines really, but the surprise here is that it beat its expectations by a decent portion. It's mainly a surprise because we're just experiencing really tough market conditions. Inflation is very high. Pepsi's kind of the type of thing that you'd imagine people could go without, but that really doesn't seem to be the case. This company's just proven what a strong moat it has and what a real defensive gem it is. Net revenue growth of 8.8%, that's actually above its average so far this year. Year to date is now 7.7% growth, which for a company of this size and scale and the growth you're expecting here is pretty good in my opinion. Earnings per share of $1.95, which is 22% change, which is slightly below the average for the rest of the year, but still was broadly in line with expectations, if not a little higher. Overall, they've done really well considering the market environment. I'd be pretty happy with this, especially considering foreign exchange impact. Being a true international company is working against them quite a lot here. Digging into this a bit more, the snack division, so Frito-Lay and Quaker Foods, both North American segments, both did really well. Gap reported change of 16 and 14% respectively. This is really what sets it apart from Coca-Cola in my opinion. While both fantastic businesses, and Coke probably has a slightly better share in the drinks market, Pepsi just diversified itself a few years ago and now has Quaker and Frito-Lay, which are both doing very, very well and have been the lion's share of the growth of this company over the last 5 or 10 years. In Europe, they were slightly down. That was the major disappointment for this. 21% growth in Latin America, so this isn't the end of the world by any means. They've made decent growth, decent single-digit growth across the board, but a 3% decline in Europe, which is to be expected really. Europe is experiencing much worse market conditions than North America or anywhere else really, and also the war in Ukraine is not helping this whatsoever, in addition to some tough foreign exchange translation as well, because currencies like the pound are down significantly to the dollar and the euro. Overall, I think this is a really strong quarter for Pepsi, particularly for the snack division, but even the beverages seem to be holding up. 3% growth in North America, which is about on par with what it normally does. Overall, I'd be really happy with this if I was a PepsiCo shareholder. Next, talk about valuation and the margin profile. Now, this company right now is trading at a premium to the S&P 500, trailing PE ratio about 26.5 and a forward PE ratio around 24, are both premium to S&P 500 right now, and that is obviously because of its defensive benefits. It's all very, very close to being a dividend king, and it certainly will be a dividend king next year, and it has really strong gross margins and a decent moat, and not that much competition outside of Coke, to be honest. They have a clear duopoly in this industry. However, the growth for this sort of pricing, the growth really isn't there. We're looking at a PEG ratio of 6.8, which is quite expensive, and a price of free cash of 39, which I would consider very expensive. I would be looking for under 20 for this. This company has a lot to like, not even talking about the dividend. Gross margins for 53% for this industry are very, very strong, and are not even particularly good for PepsiCo's own history. 13.5% operating margin is very good for food and drink. Net margin of 11%, again, very good. Return on equity of 55% is absolutely fabulous for a company of any industry really, but particularly in the food and beverage industry, this is excellent. Return on assets, quite an asset heavy business. 10% return on assets is decent. Return on invested capital over the long term of 11.5, again, for a company of this size, scale and maturity is very, very good. Again, I'm not saying anything bad about this company in terms of a margin profile perspective, I think these margin profile is very good. The fact of the matter is it's trading a significant premium to the S&P 500, and returns wise over the longer term, I just can't see it holding up to the S&P 500. One thing that concerns me a bit about this company is its balance sheet. It's quite a high debt load for a cash to debt ratio of just 0.15. Now, of course, this company, while it isn't a cash machine on the level of Google or Facebook or something like that, it produces a decent amount of free cash flow. So, and its business is not going anywhere in the near term. So this debt load is completely manageable. They have an interest coverage of 6, meaning this year's EBIT can cover 6 years of interest payments. So again, they're not in a horrendous state by any means. Debt to EBITDA and debt to equity of about around 2. I would like these to be much better. Equity to assets of 0.2 is not particularly strong for this industry at all. All this combines to give an Altman score of 4, which I think is probably a little on the high side. I would be a bit more concerned about this company. I don't think it's at immediate risk of financial stress by any means, but that balance sheet is not particularly great, and I think with that combined with a high increase in interest rate environment and a 67% payout ratio, it doesn't take a lot for the dividend of this company, which is the crux of this company's attractiveness really as a stock, to come under pressure. Now, I don't believe that is going to happen in the near term because it's a very, very strong business that's diversified. But it is a material risk, in my opinion, that the dividend could come under pressure at 67% payout ratio if this business's free cash flow drops for whatever reason. Discounted cash flow analysis is where the investment case for this company, for my style of investing, really falls apart. I would just not be comfortable paying this sort of price for this business. Using a realistic free cash flow growth rate of 5%, which I don't think anyone is going to argue that PepsiCo is going to grow its free cash flow greater than 10% a year. I think that would be very, very, very good outperformance. Its 10-year free cash flow growth rate is about 1.7%. Even when looking at earnings per share, its 10-year growth rate is 4.2%. When you use this 5% free cash flow growth rate, which I think is a reasonably conservative estimation, I always like to be conservative when doing these DCFs, a 9% discount rate for long-term returns to the stock market, and a terminal stage growth rate of 4%, that gives a fair valuation of $61 compared to a present day stock price of $169. Now, of course, DCFs don't tell the full story, it's particularly when you're looking at dividend kings that don't really have that much volatility and are generally safe stocks. It's because people don't sell them very often because they're good stocks to hold. They're a good holder for your money, but they're not going to blow the doors off with large returns. This stock is very unlikely to double over the next 5 years. So there's an element of this stock is going to let you sleep at night if you buy it at this price. However, I'm just not very comfortable holding a stock like this with trading at nearly 3 times its fair value. And that really sums it up for me. Although I think this is a fantastic business and it clearly has strong defensive properties and is likely going to keep growing that dividend over the longer term, I just would not be comfortable buying this stock at almost 3 times its fair value. I think if it was $100 or less, I would be much more tempted, but currently at $170, I just think this business is objectively overvalued for my style invested. Now, if you're interested in buying stocks for retirement, then perhaps this is a company that you want to take a longer look at because it's a different age profile to me. This would be perhaps a more bond-like return, in my opinion. You'd be happy picking up that dividend yield of 3% a year, maybe getting some single-digit growth over the stock over the long term. But I do not think this company is going to outperform the S&P 500 over the longer term, just because it's going to struggle to grow at a 5 to 10% free cash flow growth rate, in my opinion, over the longer term. I'd love to be proven wrong here because I think PepsiCo is a fantastic business. I think many people will be attracted to it because of its dividend profile. Of course, let me know what you think in the comments down below. Let me know if you think I'm right or wrong on this valuation. Let me know if you're buying, selling or holding PepsiCo right now. Of course, none of this is financial advice. You shouldn't just do what I tell you. You should analyse stocks yourself, do your own research and due diligence, and not just buy or sell because I'm telling you to. Because I'm not a financial advisor. Let me know if you enjoyed the video. Comment down below. Like and subscribe and join it. See you again next time.